Here's a detailed summary of the Walt Disney Company's DIS Fiscal Second Quarter 2026 Earnings Call, presented for easy reading and spoken delivery. Introduction. Ben Swinburne, EVP of Investor Relations. Good morning, everyone, and welcome to the Walt Disney Company's Fiscal Second Quarter Earnings Call. I'm Ben Swinburne, and with me today are our Chief Executive Officer, Josh D'Amaro, and our Chief Financial Officer, Hugh Johnston. Today, we're taking a more holistic approach to discussing Disney, focusing on the company as a whole to better illustrate our strategy and the synergistic nature of our various business lines. We've also transitioned to a shareholder letter format to provide comprehensive information in one place. As this is Josh's first earnings call as CEO, we'll begin with his remarks. Following his presentation, we'll open the floor for your questions. CEO remarks. Josh D'Amaro. Thank you, Ben. It's an honor to lead the Walt Disney Company, a company built on powerful storytelling and deep emotional connections. I'm grateful for Bob Iger's leadership, which has positioned us with strong momentum. My immediate focus is clear: disciplined execution of our existing plans, with a concentrated effort on 4 key priorities. 1. Investing in breakthrough creative storytelling. This is Disney's core differentiator. 2. Strengthening our streaming business, enhancing product and technology for more durable growth. 3. Fully capturing the power of live sports, building ESPN's direct-to-consumer future. 4. Delivering on bold growth plans at Disney Experiences, expanding our parks and resorts. Simultaneously, we are laying the groundwork for Disney's next phase of growth by embracing technology more aggressively and building a more connected consumer experience, with Disney Plus at its center. Turning to our fiscal second quarter 2026 results, revenue grew 7% year-over-year. Total segment operating income increased 4% year-over-year. We outperformed our guidance, driven by stronger-than-expected revenue growth. Key highlights from the quarter: streaming. We saw a sequential acceleration in entertainment as VOD revenue growth from 11% in Q1 to 13% in Q2, driven by both rate and volume. We also achieved double-digit advertising revenue growth. We are highly focused on churn reduction, and the integrated Disney Plus and Hulu experience is benefiting retention. International Disney Plus holds significant growth potential, with encouraging early results from increased local content investments. Our IP remains central, with recent highlights including the success of Zootopia 2, over $1.9 billion globally, and its franchise surpassing 1 billion hours streamed on Disney Plus. Pixar's Hoppers received critical acclaim, and we had a strong opening for The Devil Wears Prada 2. Looking ahead, our film slate includes anticipated titles like The Mandalorian and Grogu, Toy Story 5, live-action Moana, and Avengers: Doomsday. Disney Experiences. This segment demonstrated significant strength, with revenue growth of 7% and segment operating income growth of 5%, both setting second quarter records and exceeding expectations. We are beginning to lap previous attendance headwinds and expect domestic park attendance trends to improve in Q3. Milestones include the launch of the Disney Adventure cruise ship in Asia and the opening of World of Frozen at Disneyland Paris, extending our brand reach to new markets. ESPN. The direct-to-consumer transition continues, with enhancements to the ESPN app making the offering more compelling. Our focus remains on capturing the value of live sports within Disney's broader DTC strategy. Looking ahead and long-term vision, my strategic priorities as CEO build on our current foundation. 1. Creative excellence remains our greatest competitive advantage. 2. Deeper fan relationships, creating a more connected Disney experience across streaming, sports, games, and experiences, with Disney Plus as the digital centerpiece. 3. Technology as an accelerant, enhancing consumer experiences driving operational efficiency and unlocking new possibilities for creativity and growth. Our immediate priority is disciplined execution, but I am energized by the future. We have iconic brands, exceptional talent, powerful platforms, and unmatched experiences. Our task is to execute with rigor, invest with confidence, and connect these strengths to create lasting value for consumers and shareholders. CFO remarks Hugh Johnston. Note: the transcript indicates questions and answers rather than a separate prepared CFO statement. Hugh Johnston's insights are integrated into the Q&A section. Key points attributed to Hugh are summarized below within the Q&A breakdown. Q&A key themes and insights, strategic priorities and synergies. Josh Damrow top 3 priorities. 1. Best-in-class content creation. 2. Strengthening streaming, driving growth and profitability. 3. Leveraging live sports for ESPN's DTC business. 4. Turbocharging Disney experiences globally. Next phase of growth. Fully leverage IP across all businesses, film, streaming, experiences, products, games, for compounding value. Deepen direct fan relationships through a connected Disney experience, with Disney Plus as the central hub. Use technology as a powerful accelerant for consumer experience, operational efficiency, creativity, growth, and returns. Synergies. Disney Plus as the digital centerpiece connecting stories, experiences, games, and films. Epic Games' partnership in Fortnite is an acquisition and engagement tool, feeding into the centerpiece, particularly for younger audiences. Direct-to-consumer streaming strategy. Josh Damrow replicating Park LTV on Disney Plus. Disney Plus is being built as the immersive, interactive digital centerpiece to complement the physical parks. The long-term goal is for these to become increasingly connected, fundamentally changing the lifetime value equation as fans engage across films, parks, games, and merchandise. Driving engagement domestically and globally. Content. Continued delivery of exceptional content across franchises, TV, live sports, general entertainment, and international programming. Product enhancements. Focus on reducing user friction, intuitive discovery, and personalized recommendations, e.g., the Video and Browse initiative allowing previews while browsing. Chart reduction. Identified as the single most significant opportunity for driving value. Third-party distribution. Disney will be selective, partnering only when it strengthens the Disney Plus experience and deepens fan relationships. Bundling within Disney is seen as a successful example. Digital centerpiece. Meaning, Disney Plus becoming the primary relationship between Disney and its fans, where entertainment, sports, and experiences converge. It's a strategic posture, not just a product. Licensing versus exclusivity. Franchise and brand IP will remain on the platform, while general entertainment library content can find audiences elsewhere, which has been financially successful. Trade-offs. The Epic Games partnership is about reaching new, especially younger, audiences and driving acquisition and engagement, feeding into the core Disney Plus experience. Disney experiences. Hugh Johnston and Josh Damrow park trends. Expect international visitation and Epic-related headwinds to ease in the coming quarters as impacts are lapped. Q2 saw segment operating income up 5% and domestic park attendance down 1%. Excluding international visitation, domestic attendance would have grown. Revenue growth drivers. Strong broad-based revenue growth in Q2, 7%, driven by admissions, food and beverage, and merchandise. Pre-opening costs. World of Frozen and Disney Adventure incurred pre-opening costs in Q2, which will not recur in the second half of the year. Global guest growth. Global guest growth, parks and cruise days, exceeded 2% in Q2, with strong forward bookings indicating improved growth in the back half of the year. Macro factors. No change in consumer behavior observed due to elevated gas prices so far. Disney World bookings are pacing strongly, and cruise occupancy remains in line. However, the company remains mindful of macro uncertainties. Capital expenditure. Significant investments are being made in new ships and major expansions at Walt Disney World, Disneyland, and Shanghai Disney Resort for 2026. The majority of capital expenditure over the next decade will focus on capacity expansion. Capital-light models are also being utilized for new partnerships. Attendance inflection. Expect domestic park attendance to improve in Q3 compared to Q2, as international visitation stabilizes and Epic Universe headwinds are lapped. Content division. Josh D'Amaro supercharging content. Focus remains on investing in breakthrough IP that builds fan connections and endures, both existing franchises and new IP. Examples include Pixar's original films, Hoppers, Coco, Soul, Elemental, and their consistent output of original stories. Dana Walden's leadership. Consolidation under Disney Entertainment aims to streamline operations, unlock synergies, accelerate decision-making, and sharpen strategic focus. Walden's leadership is expected to break down silos, prioritize investment, and maintain quality. Key changes. Centralized television programming for Disney Plus and Hulu, smart windowing for linear, and integration of the games business into Disney Entertainment to cross-promote franchises and develop new IP. Technology and AI. Josh D'Amaro and Hugh Johnston embracing technology, a core priority, focusing on both internal operations and customer-facing areas. Visible improvements. Expect greater interactive entertainment for Disney Plus subscribers and more personalized content feeds across streaming services, e.g. SportsCenter for You on ESPN. Success metrics. Higher engagement and improved retention, ultimately benefiting the bottom line. Generative AI integration. Cost reduction/revenue acceleration. Focus on enhancing creativity, improving returns via efficient production and increased content volume, hyper-personalized recommendation engines, enhanced ad targeting, and personalized guest planning for experiences. Workforce productivity. Precision labor demand forecasting in theme parks for better guest and employee experiences, and cost management. Enterprise operations. Driving efficiency and cost reduction across the enterprise. Value of experiences. The experiences business is well positioned in an AI-driven content world, as consumers increasingly value authentic, real-life experiences. Portfolio of assets. Hugh Johnston ESPN and linear networks. Linear networks are viewed as brands with studios, and monetizing content across multiple platforms is complex. Disney Entertainment is already generating more revenue from streaming than linear. While linear revenues are declining, Disney Entertainment as a segment is growing. Sports. ABC is strategically connected to ESPN and sports. ESPN is in an earlier monetization transition, but is a key part of the programming strategy. The company has scale in the U.S. and is well positioned to leverage ESPN for its broader business, despite the economic transition. 1. Disney. Strength. Focus on creating, distributing, engaging, and monetizing stories and brands across the company to increase consumer lifetime value and drive compounding returns. Operating as connected businesses focused on the fan. Non-core assets. The company is continuously evaluating its portfolio and will consider strategic alternatives for non-core assets if a compelling case arises. Efficiency gains. A focus on driving efficiency and right-sizing the organization. Expense base is shifting towards growth areas like content and technology. Workforce reductions are part of a shift towards a more agile, technologically enabled workforce. The goal is to build a culture of efficiency and fund growth from within the existing expense base. Financial metrics and guidance. Revenue growth. Q2 plus 7% total segment operating income growth, Q2 plus 4% entertainment SVOD revenue growth, Q2 plus 13%, sequential acceleration from Q1's 11%. Disney Experiences revenue growth, Q2 plus 7% Disney Experiences segment operating income growth, Q2 plus 5% sports operating income guidance, mid-single digits, updated to include NFL Network transaction. Adjusted EPS growth guidance, 12% for fiscal year 2026 and double-digit growth for fiscal year 2027, excluding the 53rd week. 53rd week impact, approximately a 2% benefit on full-year revenues and a 4% benefit to adjusted EPS for the full year. SVOD entertainment margins, achieved double-digit margins in Q2, with a focus on continued profitable growth. Conclusion. Josh Damaro. Thank you, Ben, and thank you all for your time this morning. We recognize we've shared a lot of information in a new format. As this is my first call as CEO, laying out our strategy and answering your questions was crucial. We believe a unified approach better reflects the strength of the Walt Disney Company. I look forward to further engaging with the investment community and our shareholders, including on our fiscal Q3 earnings call in August. Thank you for joining us today.